Personal finance practice problem using Excel. Debt payments to income ratio. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. We're going to populate that into the blue area on the right-hand side, calculating our debt to income ratio, which you might better be called the debt payments to income ratio, because we're comparing the payments that we're making on a monthly basis to the income we have on a monthly basis. So remember, when you're looking at these kind of ratios, you want to be determining what exactly you're using them for. Are they for your own purposes, or are they for some third party, such as to try to get a loan or something like that from a financial institution? And also remember that these kind of calculations are not as standardized as those that you might see on the corporate side of things. So if you're doing this for a third party, you want to make sure that you check out exactly what they are interpreting the debt to income ratio to be, so you are in compliance and you know exactly what to be including. You also want to have an idea of what will include a more positive or negative kind of ratio. Obviously, if you're doing this for a loan, then your objective is to look good so that you could basically have access to the loan. If you're doing it for your own personal calculations, you want to be able to understand the calculations so that it can give you some insight into what you're doing and possibly be able to compare it to other people using a similar calculation so that you can use ratios to do comparisons with other people involved. So we're going to have some information down below that we just grabbed from the Wells Fargo bank site, and that's one area that you can go. Again, you might want to start at your financial institution to try to standardize, in essence, the calculations. This is what they're saying with regards to the result, which we'll look at later, and then the calculation steps that we have down below. How to calculate your debt to income ratio. We have your debt to income, which they're calling the DTI, compares how much you owe each month to how much you earn. Specifically, it's the percentage of your gross monthly income before taxes. They're taking it before taxes that goes toward payments for rent, mortgage, credit cards, or other debt. Now, notice this goes a little bit away from the debt, possibly, because they are including some components, such as if you have a mortgage, obviously that's a part of your debt payment. Credit cards are debt payments that you're going to be making. But they also include rent here, because I believe the justification is that that's going to be an obligation that you have signed up to, even though it's not officially a debt payment, because you don't own, you're not paying off a loan, you're paying the rent. So just note that depending on where your calculations are going, it might be a little bit different. You might see someone else calculate that and say, well, rent isn't actually debt. And so you want to make sure that you're in alignment using the same kind of calculation for the institution or comparison purposes to whoever else you're comparing to calculate the debt to income. Step 1, add up your monthly bills, which may include monthly rent or house payments, monthly alimony or child support payments. So they include the alimony, student, auto, or other monthly payments. And then we have the credit card monthly payments and then other debts. So most of these are debts, but notice they included the alimony and possibly rent there. And then the expenses like groceries, utilities, gas, and your taxes generally are not included. So these are items that are not going to be included, which are the other expenses, consumption expenses generally here. And then we're going to take that and divide the total by your gross monthly income, which is your income before taxes. The result is your DTI, which will be the form of the percent. And we're going to put that in a percentage form. So if we look at our data on the left, we're going to say that we have the monthly home payments or rent. So we're going to say mortgage payments or rent payments that we're going to be including, in essence, having them like debt payments. Student loan payments, so obviously that is a form of debt. Auto payments, which would be a form of debt. And then we have the credit card minimum balances payments. That's another kind of questionable component. When you have the credit card payments, you have an option to pay some certain amount. It says here in the calculations that we want to use the minimum balances. So for our purposes here, we're going to use the minimum balances, which are, of course, the amounts that you basically have to pay. And then we're going to use our gross pay. That's what we're going to assume is our earnings from our monthly type of earnings. We're going to put up top. So that's going to be on the paycheck stub. That's not necessarily the amount that's going to be deposited into your checking account, because the withholdings would typically be coming out of it when you deposit it. That would be taking out at least federal income tax, Social Security, and Medicare. So, and they wanted the income before taxes. So let's do this calculation. I'm going to say the debt payments, let's say, which again included some things that may not specifically be debt in the calculations that they have below. This is going to be equal to, I'm just going to add these up. I'm going to pull this into the inner column. We've got the 2,000. We've got the student loan. I'm going to say equals and pick up that student loan of the 300. We've got the auto payments, which is a form of loan. This is going to be equal to the 450. And then we've got the credit card minimum balances, we're going to say are the 130. Also, just note that they abbreviated this calculation debt to income ratio, which you might, interpret that to mean that the debt meaning liabilities, like the balance of the debt. But no, we mean the debt payments in essence is the calculation. So they kind of shortened the name down there, but we're really looking at the payments that we're making on debt compared to the income that we have. So we're going to underline this font group, and then we'll underline it, and that'll be our total debt. So we're going to say total debt payments. Put that in the outer column using the trusty sum equals SUM, trusty sum function, left arrow up, arrow holding down, shift up, up, up. So we got 2,880, comparing that to our income, which is gross, which we would get from the paycheck stub. Now, note, you might also be asking, well, what if I don't have like the monthly? What if I get paid weekly or something like that? Well, if you get paid salary, then you might have the salary amount that you can basically divide by 12 if you're taking the gross pay. Or if you get paid hourly and you get paid weekly or bi-weekly or semi-weekly, then semi-monthly, then what you want to do is generally to annualize it. You try to estimate it, annualize it, and then divide by 12, because that's the most accurate way typically to do it, given the fact that we have some uneven calculations. In other words, there's about 52 weeks in a year, right? And there's about 4.3 weeks in a month, and so on and so forth. So those estimates can throw off the number a little bit. So usually what you'll do is you'll say, okay, if I know my weekly or by semi-monthly payment, try to annualize it, which we might do in a future presentation. And once you have the annual number, then you can break it out into a monthly number by dividing by 12. So we might do that a little bit more in a future presentation, because that's good times to do that. And we'll compare that to the 5,500, and that's going to be our debt to income ratio, which will be equal to the debt payments of the 2,880 divided by 5,500. We're going to go to the number group, percentify that, add some decimals. We're at the 52.36 font group and underline. So that number we can kind of compare to other people, even though they have different debt payments that they're paying off and they have different income to us, but that helps us to do some comparisons. That's what the ratio is going to be used for. That's what banks will help to use the ratio for if they were to say, if you were to ask them for financing. So if you're using a bank's terms, they're going to have to standardize their calculations for their purposes so that they can compare it and use some kind of standard within at least their institution here. So 52, if we think about that, that means that our payments that we have that we're classifying as debt payments, let's do some formatting. Select these and go alignment, indent, and then I'm going to alignment indent this one again. So let's just spell check it. Debt, spelled right. Okay. So that means that our debt compared to basically our income is 52%, just our payments that we're making on the debt, not the debt itself, not the balances, but the payments we're making on debt is 5,500 of our income, or 52% about of the income. Now, is that good or bad? Well, if we go down here and we say, this is the Wells Fargo's calculations. So once you've calculated your DTI, debt to income ratio, you'll want to understand how lenders review it when they're considering your application. So if you were to get a loan application or so, take a look at the guidelines. So 35% or less, they say is looking good relative to your income. Your debt is a manageable level. you most likely have money left over for saving and spending after you've paid your bills in that case. So you can determine if that's true. If you got a 35% or less, then they're saying you're probably okay, and you can kind of test that to say, hey, after I pay off my debt, do I have enough money generally to pay off my normal bills like my food and whatnot? Lenders generally view a lower DTI as favorable. So obviously the lower number is favorable. So when you're looking at these numbers, obviously when you're looking at it and you're trying to get a loan, you're trying to be favorable there. Then what you would want to be having is the payments, whatever you don't have to include as the debt payments. You would like not to include it, if possible, to lower the top number. And your gross pay, you would like to be as high as possible. So any income that you're getting that you can include in it, you would want to have that included. So if you have other kinds of payments that you're receiving on a monthly basis other than your income from the employment, you'd like to include that if you can, because that would be a more favorable. In other words, if I increase this to like 5,000, we'd have if I decreased this to like let's say 2,000, we get a more favorable number down here. It goes down, which is more favorable. And if I increase my pay down here to like 6,000, then of course it goes down. We get a more favorable number. Now, obviously, if you're doing this for your own purposes, your goal isn't to try to get a more favorable number per se. Your goal is to get an accurate number that, of course, you can compare. Your goal is always to get an accurate number. But obviously, if you're getting a loan, you're trying to get a loan and you're trying to look good to get the loan if that's what the goal is. If you're doing this for your own purposes, you're trying to make sure that you have a number that is both accurate to you and one which you can compare to other people possibly, so that you can make determinations. So they say from 36 to 49%, we have the opportunity to improve. So that's the yellow range. You're managing your debt adequately, but you may want to consider lower your DTI. This could put you in a better position to handle unforeseen expenses. If you're looking to borrow, keep in mind that lenders may ask for additional eligibility criteria. And then if you're at 50% or more, take action. You may have limited funds to save or spend. So that would be in your red concern zone here. With more than half of your income going towards debt payments, you may not have much money left to save, spend, or handle unforeseen expenses. So that's going to be the general idea that we have here. Obviously, our numbers are a bit high, and and they're saying that we, in our case, need to take action with this example to pull it together, get our debt under control.